When most traders panic on a big gap up, this pattern can signal an absolute major opportunity if you know what to look for. Most traders see a huge pre-market gap up, they run in, they chase it, they don't know what to do, they get impulsive, and because of that, it instantly reverses on them and they, lose money because of that. What I absolute, by far and above, #1 pattern in pre-market, it is the RCT pattern. Now, a lot of you guys have been joining me on the YouTube lives and every Sunday night. Thank you for being there, but I close them out pretty much the same way because a lot of the questions will end, Tim, what do we do tomorrow morning? What do we trade? What do we look for? And if you've been on those YouTube lives, you know I say, guys, you want to know the #1 play for tomorrow morning? It's RCTs in pre-market from 7 to 9 a.m. Now, FYI, pre-market is crazy hot right now. A lot of you might watch some of the older videos that I've done on the channel, and you might be like, wait a minute, he was always cautioning us about pre-market. Now, I'm guessing if there's a video telling me to be really cautious in pre-market, it's probably about 1.5 years old. So I'm, roughly. The last 1.5 years, there's been a market shift. And one of the best, biggest things about being a consistently profitable trader for years and decades is recognizing these market shifts. So if you've heard, again, it's 1.5 years old video, you say to me, whoa, don't trade in pre-market if you're new. That has changed over the last year and a half. Now, we still can't be impulsive. We still can't chase. We still can't pile into any big stock. But by using the RCT pattern, you can wait for the stock to set up. And what I absolutely love about it is it gives you the ability to build a trade plan, which is so important, okay? If you find yourself just buying stocks, and I like to say, it's that idea of, building the plane in the air. That's what most traders are doing. They buy, and then they try and figure out, what do I do now? Okay, hopefully it goes up. What if it goes down? What if it goes sideways? And the RCT pattern determines all of that for you. So the red candle theory is my name for this pattern. I abbreviate it to RCT. So let's talk about what we're looking for, okay? This is a day trade pattern, okay? It's a day trade pattern. So because of that, we're looking at, short time frames. This is, this isn't a swing trade pattern. This isn't a long-term pattern. So a lot of these criteria you hear me talk about are going to be similar with other day trade patterns because we want explosive moves, get us in and out as quick as possible, make some good money, and then go on about our days. Or, if you're a full-time trader like me, go on to the next trade. So this is an explosive pattern and a day trade pattern. And typically most of them play out in minutes, maybe hours at the most. So going back to criteria, low float, okay? Low float stocks, traditionally the cutoff less than 10 million, but we'll allow a little bit higher than that. Next thing we want is unusual volume, a big catalyst, and a former runner, okay? So what those all mean is we've got that recipe or that box checker, I call that. And again, a lot of these criteria are going to apply to almost any day trade stock, whether it be pre-market, after the market open, late day, etc. But I just want to lay those out there. The reason we care about low float stocks and unusual volume is, remember, stock market's a market, okay? And if we can identify something, and sometimes when I say that, people are like, yeah, but a lot of people don't think about the mechanics of the stock market. And if it's a market, we're looking for extreme supply and demand imbalances. I'm sure all of you have had a high school economics class. I had one. I think I paid attention the first day, and then I got my C's the rest of the way. But in high school economics, like I'm sure across the country, like the first day, the first week, first thing you learn, law of supply and demand. I mean, it's kind of the universal rule of economics. So hopefully all of you are familiar. But real quick, the idea is if we have something, an asset class, that has limited supply and large demand, well, what's going to happen to the price? Probably going to go up fast, probably going to go up really fast. Now, vice versa, if we have something that there's a ton of supply and limited demand, well, that asset class is probably going to go lower. Think of, and I know this is a corny analogy, but it works. Think of like the hot fashion, okay? Like whatever's hot this summer, the trend, well, it's going to be full price at the store. It's going to be, $100 t-shirt. You're going to be like, holy crap, it's $100 for a t-shirt. But it's the hot thing. The stars are wearing it, whatever. they can demand that price. So that's what we're looking for with low float stocks. Now, on the contrary, think of like next year or 2 years later, that exact same shirt's at TJ Maxx, and it's like 80% off because now there's no demand. It's the same shirt, same asset, but we want to trade when there's high demand and low supply. Let the short sellers, the short sellers are the guys at TJ Maxx. Let them, after the move is over, after the momentum and volume fades, they're over at TJ Maxx, and they dress like it too. Universally, short sellers. Well, they mostly look homeless. Like TJ Maxx probably be an upgrade for them, but I saved that. So what we're looking for, low float stocks, high demand, former runners, and then, I'm going to draw these as best as I can because understand that the RCT pattern is based on candlesticks. So what we're looking for, so I'm going to mix candlesticks and line charts here because it's going to be hard for me to draw each individual candle. So what we want to see is that big straight parabolic move of 50% or more. So a lot of you see these stocks. I mean, they're tough to catch. All of a sudden you're like, you got your scanner, and all of a sudden you're like, whoa, this thing's up 100%. And you're, in an instant, like there's no real way to trade those unless you just happen to get lucky, have that stock on your, open on your platform and start seeing it start to run and pile in. Most of you, and I'm sure you can, from experience, you guys know this, you're like, what the heck just happened? It's up 50, 60, 70, 100%. Well, that's what we want with the RCT because timing is almost impossible. And again, drop me a comment. Does that happen to you day in and day out? Like, you're just like, where did this thing come from? And there's no way to be ready other than, like I said, you just happen to have that ticker up, when it's doing nothing, and you catch it before it's up 50 or 100%. But that's going to be almost impossible. It's like catching lightning in a bottle or something. So we just ignore the initial move. One thing I do want to say is, since it is the RCT pattern, the entire pattern is based on 5-minute candles. Now, I use different time frames, different candle frames, etc. And sometimes it's kind of interesting. Candles and time frames can almost be like a religious thing. Like, people will go to war. 1-minute candles, 5-minute candles, 30-second candles, 1-second candles, and they're just... Now me, I use different time frames for different setups. So if you like 1-minute candles or 30-second or 1 seconds, or I think they have like millisecond candles now, hey, it's cool. Okay, I'm not telling you what to do. But for this particular pattern, we specifically use 5-minute candles because we're waiting for that initial onrush to end. Then we're looking to trade the retest, okay? So now I'm gonna go from line charts to candle charts. So what we're waiting for is that first red candle. Now, you're not gonna know how big that candle is. I'll get into that in a second. It could be high and tight, which is what we prefer. When I say high and tight, right near the top of the initial onrush, and then a very tight body. Now, next question that I always get, what about the wicks, okay? With this pattern, we ignore the wicks, okay? I don't care after that initial top is set, and then we wait 5 minutes, because it's a 5-minute candle. You have to wait for that first 5-minute candle to be established. Within that 5-minute time frame, who knows what the range is gonna be. It could be way up here. You could have monster wicks, you could have tight wicks. But the key to this pattern is we're keying off the body, okay? The body of the candle, that's where the red candle theory comes in, okay? So you wait for that first red 5-minute candle after the initial parabolic move, 50% or above, you've got all the criteria we look for. Then, again, I'm gonna revert back to line charts. So typically what's gonna happen is we're gonna kind of, fade a little lower, and then it'll start to kind of solidify. Now, what I love about this pattern is we have two things going on here. We have an entry and a stop loss based on the body of that 5-minute candle. So now, initial parabolic move, the body gets set, and then the top of the 5-minute candle is our entry, and the bottom of the body, okay, I'll keep, because people want to use wicks, and I'm like, and listen, you can trade these any way you want. But if you want to know the way I define this pattern, and if you know this pattern, it works about 9 out of 10 days in pre-market. This is how I use it. So now, let's say this stock went from $1 to $2, and the bottom of the candle is, make it easy on me, $1.90, okay? So now, went from $1 to $2, then the bottom of the 5-minute candle is $1.90. So now we have the ability to write a trade plan, which the 3 most important criteria of a trade plan are where we buying, where we taking profits, and where we stopping out if we're wrong. So in this hypothetical example, let me kind of draw it in. So now the stock starts to turn and makes its move. The entry is the top of the body of the 5-minute candle, and I'm oversimplifying with these terms, or with the dollar amounts. It's hypothetical. Every RCT is going to be different. It works on 10-cent stocks, it works on $10 stocks. It's particularly a low-priced pattern. You're not going to see many RCTs on mid-cap and large-cap stocks, so it's mostly sub-$10 stocks, etc., penny stocks, small caps, etc. Then we've got a stop of $1.90, and now what we can do is we can use those 2 criteria. I almost think it's a simplification, but it's like an equation to map out our trade plan. So now we know we have 10 cents of risk. So, you buy 1,000 shares, you're losing $100, okay? And then you can plan out your target from that stop loss, extrapolating it out. So our initial, and I'll get into this, our initial profit taking area would be 3 times our risk. So that would be $2.30. Now I mention that because these are explosive stocks, so it's really smart to scale in and scale out. So the reason I mention initial is a lot of these stocks, when they initiate the RCT right there, they spike very fast, they go up fast, but as always in small caps and penny stocks, they pull back fast. So if we can take that smart 3-to-1 exit at $2.30, it's a good payout. 30 cents a share on 1,000 shares, it's a good day. Most of these trades are minutes, sometimes hours, but most we're talking minutes here. And then, like I said, the smart way to trade them is simply scale out at that level. So that means you take off 500 shares in this example, you lock in some profits, you've now got secured money, realized profits versus unrealized profits. You got the house's money, as we like to say. Then you can let the rest ride for the bigger move, because a lot of these spike, kind of consolidate a little bit, and then make that second leg. So if you scale out at that point, that means you've locked in some profits, and then this is the key with the RCT pattern, is now your stop is moved up to your initial entry. So with this, you now, at the worst case scenario, you leave this trade with small profits. Again, going back to my example, you take 500 shares off, you locked it in, you've got realized profits, and then if it collapses, you take the rest off at your initial stop, you secure your small win, okay? So at that point, by using this pattern, if it follows through, you can't lose money at this point. Now, if you hold all the way down, different story. Take some off at the 3-to-1 risk to reward, pay yourself, then let the rest ride unless it falls back to your initial stop. So now you're breaking even on that other 500 shares. Now, the beautiful thing is, since you lock in there, you can now lower the temperature a little bit. You don't have a bigger position. And listen, I just use 1,000 shares to make the math easy on me. I trade more. You might be trading way more, but keep the math simple so I don't screw it up. So now, less stress. You can kind of let the stock do what it wants, okay? If it decides to go sideways for a little bit, no big deal. You book some profits. You can just be patient and lower the temperature. And this is, again, what I love about using this pattern is I know a lot of you. I work with a lot of new traders. You see any green and listen, you've been struggling. Everybody struggles in the beginning. You see a little bit of green and then you just take it all off, and then the big move comes later. Now, the reason you're taking it all off is you're probably trading too big a size. You've been having a rough patch. I mean, everybody struggles in the beginning. So this is a great way to build your confidence and let the other half or third or however you decide to split up your scale outs, just let it work. So, because now what happens is that stock kind of trends up for a little bit, and then you catch that big second leg, and then that's where you take the other half off, and you've traded a repeatable pattern. You've been a real trader. You've got a trade plan. Okay, you know where you're in, where you're out. You're moving your stops as the stock goes up in your favor, or moving the stops as it goes in your favor. And it's a great way to really boost your profits because that way you're not selling the second you see green. Now let's talk about the other. As I wrap up here, what's the other contingency? Is the trade doesn't work. Well, that's fine. So let's say it hits the entry here, falls back. In this scenario, by using the red candle to determine your momentum shifts, and that's what we're doing here, okay? We're using that to track momentum. In this scenario, guess what? You lost 10 cents a share, no big deal. Nobody's ever had a 100% win rate. Nobody ever will. Keep your losses tight. But I know so many people struggle with determining entries, exits, stop losses, and goals, and the RCT does it for you. Now, back to that last point, what is the significance of this? So what happens with that first initial red candle is we're using it as a momentum guide, okay? And if the stock breaks down below that, stock's probably done for the day. We don't trade it though, okay? We only trade it if it breaks the top of that 5-minute body. Okay, so now we stay out of a lot of trades. You guys know a lot of these pre-market spikers spike and then just immediately die. This keeps you out of those. Chasers always get wrecked. You'll never make money chasing. Now you can wait 5, 10, 15, 20, sometimes an hour and 20 minutes later, and then use this to guide you all the way through the trade. So guys, please, if you're trading in pre-market, okay, and if you want to capitalize on the biggest movers right now, the action is in pre-market, particularly from 7 to 9 a.m. Now, if you don't want to trade pre-market, that's cool. Nothing wrong with that. But it's where the action is right now, and it has been for a year, and I don't see it changing anytime soon. Like I think that the market kind of has a will of its own. I've seen no signs over the last year and a half of this changing. I think this might be like a new normal situation where this may be the trend for years and maybe a decade. Like over the last 18 months, I've seen no signs of this going away. It's actually getting hotter. So if you don't want to trade in pre, that's cool, no problem. But if you do, trade the pre-market or the RCT pattern on stocks with this criteria in that 7 to 9 a.m. window. Now, last point I will make, it's a heavily pre-market pattern. I go live with my trading group every single day, 8:30 Eastern, and I'm telling you, we catch a boatload of these RCTs, like day in and day out. The reason I do it at 8:30 is because, that's when a significant majority of these happen, kind of like from, I know I said 7 to 9 a.m., but probably most of them are kind of like 8:15 to 8:45. That's why I go live at 8:30 Eastern so that we can catch these moves. If you'd like to join me live every single trading day, hit the link below. Check out the Daily Income Trader System. I'd love to work with you and mentor you.